subjective question, but then why then do you think people are screaming, not for your heads, but close, but for you to cut interest rates so much?
Well, I mean, I would say we've divided our critics into sort of equal-sized piles at this point. There's plenty of people who think that, that we shouldn't be cutting now. But the point is this: we haven't reduced interest rates. What we've said is we want to be more confident before we take that step. And I actually think monetary policy is well placed to react to a range of different paths for the data. And that's really what you want. You want to be in a position where you can react not just to the base case, but if you get a case where inflation progress slows or where the economy weakens, you're also in a position to react to that, and we are.
When you sit around the table at the Fed or on your Zooms or however you're doing it now, do you have conversations about how your desire to be more confident is received by, yes, the markets and analysts, fine, but everybody else?
So I'd say, the answer is yes, of course, but the main focus is on getting it right. Getting it right is the most important thing by orders of magnitude. If you get it right, then everything else falls into place. So, I mean, you're talking about market reaction and things like that. We look at that, of course, but ultimately, monetary policy works with a lag, and you want to make the right decisions, and you want the committee to be in a place so that if things work out differently than the base case, you're not out of position. And as I said, I think we're in position now where we can handle whatever case comes.
Can we talk briefly about that first cut, which you mentioned, right? That's going to be significant. It came up at your last press conference after the meeting. How important is unanimity to you on that?
Unanimity as such. So I don't know any Fed chairs who were hoping for dissents. It's not something you want. But at the same time, the way I think about it is this: you talk to people. I talk to all the people on the committee before each meeting in depth, and you listen to people. You hear them. You try to get in their thinking and understand it, and you try to incorporate that to the maximum extent you can in the decision and the way we talk about it. And if you do that, people generally feel consulted. They feel that their views are being considered and reflected, and they may choose to dissent. That happens all the time. It's not a problem when people dissent. It happens, and life goes on.
Do you literally go knock on their doors or call them on the phone? Like you call Mary or whoever?
Yes, I have. Well, I have scheduled calls with every voter and non-voter on the FOMC before every meeting, and not infrequently I'll have another round of calls before that, and not infrequently I will have just calls. I just talk to various people on the committee during that 6 or 7 week intermeeting period. Yeah.
Let's talk about the Fed as an institution then for a second, since we're talking about the people and how it all happens. It is, some may argue, one of the significant economic institutions in this government that actually works, right? Congress is a whole different deal. The president's concentrating on his reelection campaign. The Fed as an institution works. And you said to Scott Pelley, I think, on 60 Minutes, integrity is all we have. How mindful are you of the Fed's credibility at a time which is precarious for you?
So the Fed to me, is a very important American institution that serves all Americans on a non-political basis. And what people can expect from us is that we will do our work with painstaking care. We'll understand the theory, we'll understand the data, we'll think about the outlook, and we'll make our decisions based on that and on nothing else. We will not be making decisions particularly about political calendars or anything like that. We don't always get it right. No one does, but that's what we'll do. So integrity is everything. Ultimately in life, integrity is everything. But for us, integrity is everything, because even when we don't get it exactly right, people have to believe, and it's true, that we're doing the absolute best we can in a very transparent way, based on the data, based on our understanding of the economy and the outlook for the economy. It's tremendously important that people understand that about the Fed, and that we're working to serve all Americans, not any particular set of Americans or political parties or leaders.
You've talked previously about humility. You've said the word humble already this morning once. I was talking to Neil Kashkari at the Minneapolis Fed the other day, and he said, this economy is really tough to diagnose, so it's hard for us to know what's going on. Talk to me about humility in the face of, and we were talking about this backstage, about an economy that is still really, really hard to figure out what's going on.
So economic forecasters are a humble lot, generally, with much to be humble about.
That's funny. That's not my experience with economic forecasting.
So, but yeah, the pandemic era has, of course, been full of surprises. If you go back to the beginning, I think almost all of mainstream macro analysts thought that this was different, and that because of the obvious supply side problems, the collapse of supply chains and things like that, there was a group who didn't diagnose it that way. But if that's the case, then we thought that our very dynamic economy would recover pretty quickly, that people would go back to work, kids would go back to school, and the economy would be fine, and there wouldn't be much of a need for us to intervene, except sort of during that early period to get the economy, keep it from collapsing during the actual intense phase of the acute phase of the pandemic. So that didn't happen. Inflation came up, stayed up, and it took a long time to heal. And then it didn't really heal. The supply side didn't really heal in 2022. And we were thinking, well, maybe it's not going to heal. And then it did. And the labor force participation, workers came back into the labor force in 2023. And also the supply chains healed in 2023. So right about the time we were thinking maybe this isn't going to happen, it really happened a lot in 2023, which is part of the story of why the economy did so well last year was supply side healing. So now we have, it's been surprising over and over again. So I think we have to be unusually humble about our ability to foresee the future and be ready for different plausible outcomes.
I've told you this story, I think, the last time you and I spoke, about a conversation I had with then civilian Yellen. It was between her time as chair and Treasury Secretary, and I asked her why the Fed hadn't been able to get inflation up to where she wanted it to be, where the committee wanted it to be. And she literally looked at me and went, I don't know. And I guess my question is would it be a bad thing for you to say, we don't know, we're doing the best we can?
We say that all the time in one way or another. I'll give you an example. We have, as I mentioned, high inflation in January, somewhat less high inflation in February, and we've been saying that we expect inflation to move down to 2%, but on a path that is sometimes bumpy. So the question then is, are those just bumps, or are they something more than bumps? Is progress on inflation going to slow for more than 2 months? And that's a question, and honestly, we're just going to have to let the data tell us that. There isn't anybody who knows. And so our position is, we don't know. We'll tell you what we will do if inflation does come down. And that's sort of the base case. That is what we expect. We expect inflation to come down on a sometimes bumpy path to 2%. But if that doesn't happen, then obviously our rate policy will be different. And for example, we can hold rates where they are for longer, and that's what we would do, of course, if inflation doesn't come down, if we don't see the progress we're looking at. So we kind of say that all the time.
Consensus now is rates are going to be higher for longer. They may or may not come down this year, depending on what the data says. Do you think this economy is ready for a 4.5-ish% inflationary sort of economy, right? Not inflation of 4%, but your rates at 4.6, which is where your projections have them.
So this is one of the things. We've had our policy rate at 5.3%, which is the highest rate in more than 2 decades for some time, and all through the course of 2023, we saw very strong growth. Yep. So it's and that's partly because this has happened in a context of supply side healing, which makes its own growth, when potential output goes up. So we don't really know where rates are going to go back to when this whole thing is over. For many years, if you go back to before the global financial crisis, it wasn't unusual to see the longer term rates in the 4s. And so, are we going to go back to whereas in the sort of time between the global financial crisis and the pandemic, rates went lower and lower and lower, and it wasn't unusual to see in other countries long-term rates below zero, even. Mm-hmm. Europe. They never went that low in the United States, but they went very low. So are they going to go back up to those higher levels of the pre-global financial crisis? We really don't know. We think that the factors that led rates to really came down over a 40-year period, mostly related to big, slow-moving things like demographics, aging population, which saves more, and productivity, low productivity, and things like that. Those things don't jump around. They're sort of slow-moving objects. But the truth is, we don't know. My own expectation is I don't think rates will go back down to the very, very low levels they were at before the pandemic. But where they will turn out to settle out, it's hard to say. This economy doesn't feel like it's suffering from the current level of rates, although if you look at things like inflation-sensitive spending, then those parts of the economy are really feeling the high rates.
Not to pick at a scab, but what I hear you saying is, while inflation may or may not have been transitory, rates are not actually going to be transitory. They're going to be higher for a while, and people just need to get used to that.
That might be the case. I don't know. I don't think rates will go back to the very historically low levels that they were at before the pandemic hit. I do think rates will come down are likely to be lower than they are. At least short-term rates are lower than they were right now. But I mean, we're going to let the data. We're going to have to let the data tell us the answer to that.
I want to go to the labor market for a minute. Something you said at your last press conference sort of caught a lot of people's ears, and that was when you said, we are very attentive to both sides of the mandate, which is to say full employment and stable prices. And people picked up on that because you had been very keyed in on the price stability aspect. And I guess I wonder now why you're becoming more aware, or publicly saying you are more aware of unemployment.
I'll tell you why. So we have two mandates, as you know, maximum employment and price stability. And when one of those mandates is far from its goal, and the other one isn't, you focus on the one that's far from its goal. And that's actually in our document that codifies the way our framework. So that was the case from the late 2021 until inflation started coming down. And so we focused very hard on inflation, and you heard us talking about inflation. But headline inflation just a year ago was I guess 5.2% on a 12-month basis. Now it's 2.5%. And core, I think, has come down from 4.8 to 2.8. So you've seen really significant progress. Just as a natural thing then, the work's not done. Our goal is 2%. But as that happens, the risks to the two goals come into better balance. They're coming into better balance. And that means we are a dual mandate bank under law. That means that we now that thing we were doing, we were just thinking about inflation, that's no longer appropriate. So we're thinking about both. We're thinking about the risks to both now, and we should be. That's our job under the law. And so, we're very committed to getting inflation down to 2%. Having it down to 2% is critical if we're going to have the kind of long expansions that really benefit all Americans in the workplace. At the same time, if we were to see unexpected weakness in the labor market, then that's something that we would be looking at carefully and could draw a response as well.
A policy response, clearly.
Yes.
Yeah. What's the monster under your bed? What keeps you up at night? Other than inflation, you don't get to say inflation.
Inflation.
No, you can't do that.
No, I would say this. We're at a place where the economy is strong, without question. The labor market's in a good place. We've got unemployment under 4% for more than 2 years now, for the longest time in 50 years, and we've had progress on inflation. So we want to use our tools in a way that keeps the strength in the economy and in the labor market, but allows for further progress in inflation. That's our focus. And we clearly have a chance at that outcome, and we're all very, very focused on doing everything we can to deliver that outcome. It would be a great outcome for the American people, and it would be testimony to how unusual the circumstances are.
Soft landing, transitory, words that I imagine you don't let be said in your presence very much. Here's another one that hasn't been said at a press conference that you've had since December: recession. Do you think a recession's off the table?
So there's always a sort of unconditional probability of a recession in the next year. And so the real question is, if you look through history, it's not possible to rule a recession out for a long period of time. So,
Granted, but you know what I meant, right?
yeah, no. The real question is the possibility of a recession elevated at the current time? And I would say no. I don't see forecasters disagreeing with that. Growth is strong, as I mentioned. The economy's in a good place, and there's no reason to think the economy is in a recession or is at the edge of one. But humility.
Understood. Last time you were on the Hill, somebody asked you whether you were going to come out and declare victory. You were going to say, oh, yeah, we did it, we're done. And you said, absolutely not, that's not what we do. Will you not at some point, though, when you get inflation to 2%, say, inflation's at 2%, we've done our job, things are stable and life is good?
I don't want to speculate about that. We'll jinx it. Okay. So I'm such a superstitious person, but no, look, we'll always tell you what we're seeing in the economy, and if we get to that place, that'd be a great outcome for the public. That's the main thing.
We talked very briefly backstage about after the Fed, what you're going to do, because you have 2 years left, give or take. As we sit here in the Yellen Conference Center at the San Francisco Fed, where do you think the Powell Conference Center is going to be? And what do you think your legacy is going to be? First line of your New York Times obit.
I'll tell you the thing that I care about the most, and that is the Federal Reserve as an institution, as I mentioned, is an incredibly important American institution, especially right now, because we are that place. We aspire to be that place that transcends politics, divisive politics. And I think, in a way, we are helping hold this thing together by doing what we do the way we do it. And I want to be, I feel accountable and responsible for the institution and delivering it to the next generation of leaders and people in a way that it can still serve the American public the way the Fed does.
So I wasn't actually going to go to politics this morning because you have a well-practiced answer to that question, but I feel like I kind of have to now that you brought it up twice. It is possible that the Fed is likely even that the Fed is going to become more politicized this year. And the first time you and I spoke in 2018, you were in the crosshairs of the president and the administration. And I asked you about it, and you said, you know what? Control the controllable. Can't do anything about it. So the question is not what are you going to do about the politics of it? The question is, what is your fear for the economy if the Fed becomes politicized?
It just wouldn't. We wouldn't be the Fed. But the good news is we are the Fed.
Come on, no. That's not answering the question.
No, a central bank that is excessively responsive to. You have to look at other countries, basically. And what you see is there's no credibility. Credibility on inflation and on sticking to your knitting is everything. Because if people believe that you will accomplish your goals and that you won't deviate from them for reasons like that, then it'll be easier to do so. Markets will react appropriately, and in people's thinking, inflation should be around 2%, and if they think that way, then it probably will be around 2%. So if you look at I think of more emerging countries where they have weaker independence or a lack of independence, it's just it's hard to have price stability or maximum employment. So that's what would happen if that were to happen. But I'll insist upon saying that's not the world we live in.
Fair enough. One more question along those lines, and then I'll leave it be. You don't comment on fiscal policy. This is not a question about fiscal policy. It's a question about what the Fed will do if our current fiscal path, which many have called unsustainable, including Chair Yellen when she was chair and in the interregnum. What do you do if our fiscal path continues? What does the Fed have to think about?
We're always going to do what we need to do with our policy tools to achieve the goals Congress has assigned to us. And that means maximum employment and price stability. So we're not going to be thinking, gee, we shouldn't raise rates for fiscal reasons. We're never doing that. We're always going to use our tools, and we're always going to assume that the fiscal authorities can run their side of it and can get it under control. And I think it's what I said and what Ben Bernanke said and what Janet said, and I'm sure Alan Greenspan said before him, is we're not on a sustainable fiscal path. That's an uncontroversial statement. And the sooner we get on that path, the better, back on that path.
A word here about the balance sheet. You said you're going to slow the runoff and sort of keep an eye on things and how they go. Does it suggest a worry about the economy that you're going to slow the runoff of the balance sheet?
Not at all. So we published the thing about the balance sheet is we want to be highly transparent and predictable. It's not the main story about monetary policy. The main story is interest rates. What happens is when we get into a very difficult situation like the pandemic or the global financial crisis, we buy treasuries to lower interest rates and to support the economy. And then we're left with a bigger balance sheet, and we start to then, when the time is right, let it run off and shrink back to where it needs to be. So that's what we're doing. And what we said was, at a certain point, we would slow the pace. And the reason is, it's moving down quickly. We've decreased the size of the securities portfolio by $1.5 trillion over the course of the last year and a half, not even year and a half. And so we've said that we would slow the pace, and what we're trying to do there is try to actually get further without being disruptive. The last tightening cycle for the balance sheet ended when we suddenly found ourselves that we'd gone too far. And it was very disruptive to markets, and we had to buy treasuries to create more reserves in the economy. So this time we tried to learn from our first experience with shrinking the balance sheet, and this time we said we would slow at a certain point. But we're going to get to the same point or even lower than we would have, and it's not at all in any way related to a concern about the economy. It's our plan.
On that word transparency, which you've mentioned a couple of times, and on your policy and your predecessor's policy and those of the committee and the board of governors of transparency and giving forward guidance and letting everybody know what you're thinking and what your plan is. Why?
The old school was tell them nothing, be mysterious about it. And then a bunch of scholars 40 years ago, people like Alan Blinder and others, thought about it and said, if the public understood your reaction function, the way you would react to different kinds of data, then that'll make your job easier, because markets they'll go, oh, I see, the data came in, let's say that some data comes in hot. Data comes in hot, the Fed will do X, so we'll react that way. So in effect, the markets and the public will understand what you're doing is a good thing, and that was very novel. So the path went from tell them nothing. The Fed didn't even announce what it did at an FOMC meeting until 1994. The first post-meeting statement that's saying, hey, we raised rates or we didn't, was 1994. So from there, you have a straight line, really, of increasing transparency to the point where you are now, where you see a lot of transparency. Some people say it's too much, but that's the idea. And I think you've gotten to a place where we try to be so clear in what we're doing that the public will understand what we're doing and why, and that actually helps our policy be more effective.
Humor me. What happens if everybody's anticipating a cut in June, but what happens if you guys out of nowhere came out and at 11 o'clock Pacific time, I know it's different for all of you in different time zones, the statement came out and said, we cut 25 basis points today without having given anybody a heads up? What do you think happens?
Nothing good. I mean, I think we would...
Seriously?
Well, what
everybody goes, yay, rate cut.
No, but we would, look, we are careful, thoughtful, we're steady hand. If we did things like that, it would be very much not the way we do business.
No, it wouldn't, but play it out for me. What do you suppose happens? Seriously, humor me.
I think if we did something like that, markets would say, we thought we understood the Fed. We've spent years. Someone would go on TV and said, I've spent 30 years watching the Fed, and I don't understand this at all. Why'd they do it? In other words, doing an off-cycle rate cut, like at a time like that, it's just something that would never happen. I mean, if there were a reason. So we when the pandemic hit,
those we all know.
We did two off-cycle meetings in one cycle, and then we canceled the actual meeting. So
and look what happened then.
Well, that was
we had a pandemic.
That was what needed to happen. That was what needed to happen.
Do you worry that the Fed gets covered too much, especially now when we're all trying to parse your every word? Gets covered too much like a horse race kind of? There's a little bit of who's in front, polls say this, what are they going to do?
Yeah, I do worry about that. I think that the things that really matter for our economy over the long term are not the Fed's interest rate decisions, which really have no impact over the things that matter on the long
Say that again. Seriously, say it for the cameras.
No, okay. The things that matter for the United States economy over the medium and longer term are not the decisions the Fed makes. The Fed tries to guide the economy to maximum employment and price stability through a business cycle and can react. We do critical things during crises. We're very, very important in crises. But things that add to the productive capacity of the United States, things that give people more skills so they can contribute more to the economy, things that increase productivity so that an hour's work is worth more output. That's the evolution of technology. It's also the skills that people have. Those things, investing in those things, that's what drives the longer run growth and the longer run economic well-being of our citizens, not the things that the Fed does. What we do is very important in maintaining stability and smoothing out the business cycle and also crisis response, but we don't work on those really far more important longer run issues.
Apologies to those of you on the live stream and who are going to hear this later on the radio. Is Professor Swanson in the room? Sir, I'm sorry, I'm going to steal your thunder. There's a panel coming up this afternoon, sir, at 1:25, the title of which is Speeches by the Fed Chair Are More Important Than FOMC Announcements. An improved high-frequency measure of U.S. monetary policy shocks by Professor Swanson at the University of California, Irvine, and some others. Agree or disagree?
Pass. No, I look forward to. I saw that on the agenda. I look forward to. I'm not going to come in here and embarrass you by being here, but I will. I will read the paper.
But to that general point, do you get too much press?
It's not for me to say, but I do think
it is for you to say. It's literally for you to say.
I absolutely think there's too much focus. If you think about the things that are really important in the economy, things like trade and what we should be doing, some of the things that we're doing that the administration has done, they're far more important over the medium and longer term than monetary policy is. Although it's important that there be a Fed that has a good framework of monetary policy that's well understood. Very important that we do our job, but don't get me wrong, it is important, but absolutely the other things are more important over a long period of time for the people we all serve.
Around the last time you and I spoke in 2022, I also talked to Chair Bernanke about his book, and I asked him whether you two ever talk on the phone, and he said, yeah, he calls me every now and then, mostly he imagines as a courtesy to him, and I said, well, Jay Powell's a good guy, he probably just calls you. And he said, when Jay was new to the Fed, he used to come down to my office on a Saturday morning with another governor or two, and we would just talk about monetary policy as he was trying to learn. And I guess my question is, do people come to you now?
Oh, well, they don't necessarily. I don't go to the office on Saturday anymore, but Ben used to go. Ben was in the office on Saturday, and when I was a new governor, so was I. So, and I took advantage of the fact that he was there in his office and we could chat. It's a much more relaxed way. I talk to people. I work at home now on the weekends, and I talk to all kinds of people all weekend long. Yeah.
Who do you go to though for counsel?
Well, I talk to my colleagues on the FOMC. I talk to senior staff. I talk to the formers. I talk to both. Janet is now Treasury Secretary, so that's a different thing. But I check in with Ben. I check in with other former Fed people. I can't, you can't get the group of people that you can really talk to is pretty small, but I do take advantage of that. Why wouldn't I?
Back to Kashkari for a minute and the interview I did with him. Well, explain that.
What?
A little chuckle.
He said back to Kashkari.
Well, Neil's an interesting guy. One of the things we were talking about was consensus. I mentioned that before. Do you worry about groupthink around the table? Talk to me about the strength of the conversations, I guess. That's the question. So this the robustness of the debate.
This is a virtue of our federated system. So we have 12 reserve banks. Each reserve bank has its own economic staff, and they have traditions, some that they follow or don't follow. But in any case, you sort of have a guaranteed institutional diversity of perspectives, institutionally guaranteed diversity of perspectives. People come in and they're going to have different views, and I think that's absolutely critical. And I do think the fact that we were able to get a unanimous decision on something doesn't mean there weren't different views. Also, remember, before the vote, there's a lot of discussion that goes on to try to arrive at a plan that people can get behind. So it's not, that also tends to minimize.
Sorry, let me just pick up on that. Is it baked before you guys get in the room on the Tuesdays and Wednesdays?
It's not fully baked, but yes, you do a lot to. Of course, my part of my job is to know what people think and to come to the committee with something that has really broad support, and that's part of the thing that I do. But we do have different perspectives, and that's really healthy. I was an investor for quite a while, and when everyone agrees that something is a great investment, you got to really worry. You want somebody who's really smart to explain why it's not, so that you can go through the process of hearing the case against. And I think it's really helpful to hear different views, so that you can sort of test your own perspective. If everybody agrees that it can be kind of flabby. It hasn't really been tested.
Mary Daly in the introduction was talking about your special talent, that you're a listener, you're a consensus builder. What is your special talent? Why do you think you have this job?
Why do I have this job?
Don't ask me, man.
It's when I got to the Fed in 2012, of course I had no idea what was to come. I will say what I try to do on listening is, I think if you do listen to people and they understand that you're hearing them and not just kind of explaining things to them, and they get that and they feel listened to and heard from, for most people, most of the time, that's going to be enough for them to go along, even if they don't like a decision. It builds relationships. So, I spent a great deal of time with our oversight committees and beyond that on Capitol Hill, and more so than my predecessors. And I think, they see the Fed as, I want them to see the Fed as what it is, which is this non-political agency that doesn't run talking points at them and isn't political and is just doing our work and staying out of the political issues. And, I'm in their offices listening to what they say, and I think they really appreciate that.
Yeah, but do you think it's working?
What?
Your effort to get them not to see you as a political agency and just doing the best by the American people.
Much better than you would think. I mean, I think there's a certain amount of low noise on that subject, but if you talk to people privately, I think the Fed has an independent Fed has very broad support in both parties on both sides of the Hill.
I'll appreciate you're going to want to be discreet on this question, but what's running through your head when you're at the green table in front of a Senate or a House committee?
I'm trying to listen hard to find to get the question, and sometimes the questions are more like speeches, and or they're not really questions, or they're not quite the right question, and so I try to find the good question and give the good answer to that question. Also, respect. We in our system of government, they are our oversight, and our democratic legitimacy runs right through transparency and right through their actions of holding us accountable and being explaining to them what we're doing and why. So we answer any and all questions that they may have, and so I work hard to get ready for those with a lot of help from people, and we take them very seriously.
Banking regulation. New regulations are in the works. Banks are not happy about it from, from Wall Street down to community bankers that I talk to. What's your confidence level first of all, about the banking system right now, and then about the need for more regulation? Can you fix what you think is wrong?
Sure. So I would say the banking system is in a good place now. A little over a year ago, we had a period of stress. I think things have settled down significantly. I think banks are lending. I think we focused a lot of attention during that period and since on banks that had things like CRE, commercial real estate losses, or perhaps funding structures that needed to be supported more. And we work with a ton of banks to address those issues. And so I think the banking system is definitely in a good place. I think the commercial real estate problem will be with us for some years, but it is just a question that some banks, and it's mostly small banks, it's definitely not the very large banks, have have concentrations of commercial real estate, and it looks like they will be realizing losses over time. And we're working with them to make sure they have enough capital, that they do understand the losses, and so that they can work through this. And so that's what we're doing. And again, that process will play out, and I think that'll be okay.
I talk to a community banker every now and then up in Seattle, and she basically, I think I don't want to put words in her mouth, but I will. I don't think she would characterize it as working with. I think she would characterize it as the Fed's telling us what to do. And I guess I wonder what your response is to that.
Well, supervisors, we have a job, which is to make sure that banks understand and can manage their risks. And, it can be either of those things. It can sometimes, certainly supervisors have to at some point say, you got to do this. And that's one of the lessons of the Silicon Valley Bank situation was a need to be forceful when it's appropriate.
Sorry, let me dig in on that just a little bit. Forceful is one thing. Well, let me phrase it a different way. Do you need to convince the banks that you're working with them, or can you just say, you got to do it, sorry?
So I think I've never worked as a bank supervisor. So, but what I believe is this: bank supervision can tend to be pretty process oriented, mm-hmm. And there's a playbook, there's a checklist, and that's a good thing because you want the banks. It wants to be transparent so that they know what's expected, so they can do what's expected. But it can also be slow when it needs to be fast. And so the art of it, and there's definitely an element of art in this thing. And some people are just very, very good at it, and others less so. But you can see the art of it, though, is for the banks to understand. Generally, banks, banking is different from many other industries. It is a heavily regulated and supervised industry, and they, particularly the larger institutions, they have ongoing daily interactions with their regulators and supervisors. What's important is that the banks are well capitalized, that they understand their risks and they can manage them, that they have adequate liquidity, that they have good resolution plans. And our job is to make sure that that's the case. The more the banks take that on themselves and do a great job at it without us pushing them, the less we need to push.
The international situation. The United States is doing better than every developed economy, I believe, in the world by a good measure. What do you make of that, and how does it affect your decision making?
So I do, a fair amount of my job is going to these international meetings, either in Basel or whoever's running the G7 or the G20 in a given year, and that is what people are talking about, is the sort of exceptionalism right now of the U.S. economy, how strong the U.S. economy is. And there's no question that we are performing very well. I think part of it just is productivity is a key thing. The Europeans are very focused right now on not just their short-term low productivity, but what can they do to have greater productivity growth over time. This is a big focus for the European economic officials at the highest level. Mario Draghi is doing a report on it. And the finance ministers that I talk to from the big countries, this is their focus. And so it's tremendously important. And so people are thinking about what can we do. Some of the things they're looking at doing sound like the United States, like having a flexible labor market and having a very active financial sector that can fund early stage or small companies well. So it's very important. And so yeah, the U.S. is doing the performance of the U.S. economy in the last year or so has been quite strong.
Does that affect how you do your job?
Yes, it does.
Discuss.
Well,
I'm going to have to take the punch bowl away.
Seriously?
Apparently.
Oh man!
I know it goes fast when you're having a good time.
My job is to hit a time post, and I can't even do that.
Well, apparently not. No, but I'm your helper. I am on stage, ready to help you.
Sorry, Mary.
Chair Powell, I'll turn it back to you.
As I mentioned earlier, the fact that the U.S. economy is growing at such a solid pace, the fact that the labor market is, still very, very strong, gives us the chance to just be a little more confident about inflation coming down before we take the important step of cutting rates. And so we're not going to take that step until we are confident, or we don't think it'll be appropriate to do so, I should say. But that's the way it plays into what we're doing.
Over to you, boss.
Okay, thank you very much, gentlemen. It was a terrific conversation. I appreciate it.
Thanks, Mike.
Thank you very
Appreciate
much.
it.
Thanks, Gary.